We'll be going over IRS Form 6252, Installment Sale Income. So this is a form that you would complete and attach to your income tax return if you sold an item of property under the installment sale method. In the installment sale method simply means that you collected interest over more than one tax year. So in this case, we're going to walk through this form through our taxpayer's eyes. And in this case, he's selling a rental property. And so he's using the installment method, and you simply complete this form for each year of the installment agreement. So we're going to break this down into three different parts. There's this area at the top that I just label in our article top of the form, but then really there's part one, which is the gross profit and the contract price. This is where you're going to calculate the overall profit that you realize from the sale of the property. And then part two is going to be the installment sale income. So basically how much of that profit you received in the year of the installment agreement. And then part three is optional. Well, it's not optional, it's either or. So most people won't complete part three if you, unless you sold to a related party. And the IRS has definitions of what a related party is, but generally speaking, if you own a company and you sold this to a business partner, a family member, someone with a financial relationship, generally speaking, that would be considered related party. And even if that's the case, you would not complete part three if you finished or completed the final payment this tax year. So let's go to the top of the form. As I mentioned, John Doe, his social security number, and he's selling a rental property. Now you see this 4 here, and that's based on a code in the form instructions that help you kind of understand the circumstances of the installment sale. So code 1 would be a timeshare or a residential lot, and that would be defined as unimproved land. So you could read the instructions and think, maybe this is category 1. It's not. It's an actual rental property. Category 2 would be personal use property under Internal Revenue Code section 1275B3. Item 3 would be any property used or produced in the trade or business of farming. And then category 4 is all other installment sales not listed. That's why we have a 4 here. So we acquired this property in 2022, and we sold it on the 1st of January in 2024. So this clearly falls under the category of long-term capital gains treatment. You would be possibly completing either Schedule D or IRS Form 8949 or both, and possibly IRS Form 4797, which is the disposition of business property. So the item 3, even though we're going to complete part 3 for the purpose of this, let's just check no, but we'll walk through part 3 as if we checked yes anyway. And then item 4, can the total selling price be determined by the close of the tax year in which the sale or other disposition begins? So, in this case, that's a yes/no question. So we just entered yes, and we'll just move on to the next one. So now we're going to start part 1, which is determining the gross profit and the contract price of the entire sale. And you're going to complete this for all years of the installment agreement. So let's start with the selling price. That's line 5. This would include any cash that you received, the face amount of the installment obligation, any fair market value for property or services that you received, and mortgages or other debts assumed by the buyer as part of the property. However, you would not include any interest income, whether it's stated or unstated interest, you would not include that in line 5. In line 6, you would enter any mortgages, debts, or other liabilities that you transferred to the buyer. So you're not going to include any new mortgages that the buyer obtains from a bank, only an existing mortgage. So in this scenario, we sold a $200,000 rental property. We had an existing mortgage on it for $50,000. So realistically, line 7 is the difference, $150,000. That's going to be what we're calculating kind of our cost on. So line 8 is the cost or basis or other basis of the property that was sold. So you're going to enter the purchase price, other expenses that you incurred. You're going to add the cost of improvements. So for a rental property, there's a difference between improvements and repairs. So we're only including the cost of improvements. An example of an improvement would be if you renovated the kitchen as opposed to just fixing appliances in the kitchen. So renovating a complete kitchen renovation would be considered an improvement. Replacing appliances in the kitchen would be considered an improvement, but just fixing your dishwasher would not be considered an improvement. You would also subtract any casualty losses, as well as a long list of credits that you can find in our article or the form instructions. So there's a long list of credits that you may need to back out of that property, in which case that's kind of out of the scope of this video. It's just a long list, but you can check that list in our article. And I'll tell you at the end of this video how you can get to that article. In line 9, we're going to enter the amount of depreciation that was either allowed or allowable from the date of purchase to the sales date. So basically, the difference between allowed or allowable is that any depreciation, for example, on a rental property that you were allowed is what you actually claimed. The allowable depreciation is what you were entitled to claim, whether or not you claimed it on your tax return or not. So either allowed or allowable. And as well, you're going to have to add back any deductions that you might have taken. Again, there's a long list of deductions that you can find in our article. Most of them don't really have to deal with rental property, so I'm not going to go over it in the context of this video. In line 10, you're going to subtract line 9 from line 8 and arrive at your adjusted basis. So in this case, we've got our basis of $80,000. That's based on the $200,000 selling price minus our mortgage. That's our new sales price. But then how much our property cost was $100,000. That includes the purchase price, any improvements, minus the $20,000 of a depreciation helps us arrive at $80,000. Now, in line 11, we're going to include commissions and any other expenses. These could be advertising expenses, attorney fees, legal fees, typical kind of closing costs. And then item 12, line 12 would be any ordinary income that was recaptured under section 1245 or section 1250. This is fully taxable in the year of sale, even if you didn't receive a payment. So you will see this come up again, but basically you're paying the tax on the income recapture of depreciation that you might have claimed in prior tax years. You're going to claim that as ordinary income in the year of the sale. In line 13, we're going to add up lines 8, 11, and 12 and arrive at $100,000. We're going to subtract that from the $200,000 selling price, and we get $100,000. Now, if this is 0 or less, then we're not going to complete the rest of the form. We would instead report the transaction directly on either form 4797, form 8949, or Schedule D of your tax return. But since this is a positive number, we now need to figure out what we're going to do with that. And I'll back that up. A zero number basically means that it's a loss, and you can't use Form 6252 to report a loss. You would simply report that loss on one of the forms or schedules previously mentioned. So that's why you would stop right there. Now in line 15, we're going to determine whether or not this was your main home. You would enter the amount of your excluded gain. Otherwise, you would just enter 0. So this wasn't the primary residence. So we're not excluding any of the capital gains under Section 121 of the tax code. So we're simply going to enter 0 here, and then we're going to bring this $100,000 down. That is our total gross profit. That's going to be the number that we use to help determine how much income we're realizing in each year. So $100,000 of gross profit, we're going to spread that out over as many years that we're receiving payments under the installment agreement. Line 17, we're going to subtract line 13 from line 6. So that ends up being 0. And then we're going to add line 17 to line 7. And that gives us $150,000. For intents and purposes, this is our contract price. And that's going to be the price that we're going to use to determine our gross profit percentage under Part 2. So in Part 2, we're going to calculate every year that we receive payments, how much of the payment is basically a return of our basis, and how much of that payment is gross profit. And then we're going to report the profit, and we're going to not report the basis on our tax return. So line 19 is a calculation of line 16 divided by line 18, the gross profit over the contract price, and we get 2/3, which is a decimal 667. And then if this is the year of the sale, you would enter the line 17 amount, which happens to be 0. But if this is not the year of sale, you would enter 0 anyway. And then in line 21, let's just say that John Doe received $20,000 during the year. You would not include interest, whether or not it's stated or not. But it would be any money, any fair market value of property or services that you received in that year. You would also include any amounts that were used to pay off a mortgage or other debt, or to pay real estate broker fees, legal fees, things of that nature. You would not include a buyer's note, a mortgage, or any other debt that the buyer assumes. But that note or a debt that's payable on demand on an established securities market could be considered a form of payment. So if it's just straight cash, it's going to be easy for you to figure out. If you're bartering properties or services, you're going to have to determine what you include and what you don't include in this number. You'll add lines 20 and 21, and in this case, we get $20,000. Since this is the year of sale, we don't have any payments that we received in prior years. But you would include any other installment income or deemed payments from prior years. Deemed payments would, there's a definition of what deemed payments are, so you can find that in our article as well. It helps you break that down, but it's probably a little clunky to explain during a video where this might not apply to a lot of people. So our installment sale income happens to be whatever line 22 is multiplied by this decimal here, and we get 1333. And I realize a mistake that I made here when I was pre-filling out this form. Let's just say that all of line 24, this is the ordinary income under recapture rules, again, based on IRS Form 4797 that we claimed in the when we when we're going to claim that recaptured depreciation, when we're going to recapture that and report it as ordinary income. So this should be the same amount. If for some reason this was like $20,000, we could only claim up to $13,333, and actually, you'd put the entire $20,000 in there, and then you would have a negative number to report here. So we're going to make this number up here on line 12 the same as the ordinary income that we're claiming here, which means that the capital gain amount of this would be $3,333. Now, we wouldn't have to complete part 3 based on what we reported, and you don't need to complete part 3 if this is the final year of the installment payment. But you can find the definition of what a related party is, in our article. But let's just say that John Doe sold this to his father, James Doe. So now, is there a second disposition during the tax year? In other words, if John Doe sold the property to his father, did his father turn around and either dispose of the property or sell it during this year? So if the answer is no, then you basically don't need to complete the rest of this. If the answer is yes, then you would go on to question 29. So question 29 says you still have to complete lines 30 through 37 unless there's one of these conditions that's an exception which applies to your situation. So if Jim Doe sells the property more than 2 years after he bought it from John, then you can check this box and you don't need to complete the rest of it. If the first sale was a sale or an exchange of stock back to the issuing corporation, so this would be if, John Doe was the CEO of Doe Enterprises and he's selling stock back to them, there's a stock buyback or something like that. If Jim Doe had something like eminent domain and there was an involuntary conversion, and that eminent domain all happened after he bought the property from John Doe. So in other words, John Doe had no idea that there was going to be an eminent domain declaration, and when he sold it to his father finds out on his watch that the government's coming in to seize his property and they're going to buy it out for him from him. Then he could check box C. If the original seller or buyer died, then Jim can sell this whenever he wants without having to complete the rest of this. And then in box E, if the IRS is otherwise satisfied that tax avoidance was not the primary purpose for any of these dispositions, then you would need to attach an explanation that kind of says this is what it was. So if there's a foreclosure, and generally speaking, the IRS will apply that exception to the second disposition if it wasn't voluntary, like if Jim Doe had to sell it because he's being foreclosed upon, or if there's a bankruptcy. If the subsequent sale was an installment sale that's even longer, so if Jim Doe had a 3-year term, but now he's selling it under a 5-year term, as long as the resale does not allow him to defer his recognized gain from the first sale, then he could meet the IRS criteria. But for box C, you would need to put an explanation in here that kind of that justifies the situation. So let's just imagine that he doesn't meet any of these criteria, and now we're just going to walk through lines 30 through 37. So in this case, we're going to enter Jim Doe's contract price. So let's just say that he had $500,000. He turned around and sold this for a pretty penny. In line 31, we're going to take the line 18 for the year of the first sale. So that's the contract price right here. That's what he bought it for, $150. And now we're going to enter the smaller of either $150 or $500,000. There we go. In line 33, we're going to enter the total number of payment or amount of payments received by the end of the tax year. So if you completed part 2, then that would be the total of lines 22 and 23. So let's just say that's $20,000. We're going to subtract this from line 32 and we get $130,000. And then we're going to multiply this by the gross profit percentage up here. So 133 times 2/3. Sorry, 130,000 times 2/3 gives us 86. And then we would enter the part of line 35 that is ordinary income, subtract, or that is subject to recapture. So for line 36, basically we would enter the instructions for line 25. So let's say it's that $10,000, and you would enter this amount after you subtract it on here and on either Schedule D or IRS Form 4797. So realistically, you're kind of looking at having to report, this larger number if this is installment sale income to a related party, because you're having to recognize the gain of that related party. So for most people, that shouldn't be the case, but that's kind of the workaround that the IRS has to prevent people from using this to just kick the tax can down the road. So most people are never going to have to worry about Part 3. Again, there is a definition of what related party means. Most arm's length transactions, you wouldn't even consider completing Part 3. So it's really just kind of the rote calculation of Part 1 and Part 2. The trickier parts would probably be figuring out where to recapture your depreciation and making sure that you've got everything lined up between your depreciation from prior years, your Form 4797, your Form 8949, and your Schedule D. So that's all we have here. We have updated our article. There were a couple of changes from the prior year tax forms. So if you need to drill down for more details, feel free to check out our article. You can find that at teachmepersonalfinance.com. Type in IRS Form 6252 and you'll see the article appear. We'll also put a link in the show notes to the article, as well as articles and videos we've created about some of the other tax forms mentioned here. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if there's any ideas that you have for an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.